Hi, thanks for stopping by and tuning in for another dose of bite-sized bits of knowledge where we give you a meaningful amount of information in a short amount of time. Today, we're going to dive in a little bit more to income tax basis 101. Income tax basis 101. We've already kind of talked about the different taxes that are applicable to estate planning. So today we're going to talk about tax basis 101. All right, here's what you got to know. There's something called basis or tax basis. If you're familiar with it, skip this video. Or maybe not, because this could be useful. I'm going to use a concrete example to make this point, but it applies to every asset the same, whether it's a watch, a boat, a bank account, a business, or whatever. It's all the same, okay? In this example, we're going to talk about a house. You buy a house for $100,000. Doesn't matter how you finance it. Your basis is your purchase price. Your $100,000 basis is your purchase price. Okay, say that you improve the kitchen. You invest, $25,000 to improve the kitchen. It's a beautiful kitchen. Your basis increased by the amount of that investment. It's an investment in the fixture of the house. It's not something you're taking with you. So it will increase your basis. This results in what's called an adjusted basis. So your adjusted basis is now 125. Say that you build a pool. We're talking about South Florida here, it's not uncommon. Pool costs another $25,000. Your adjusted basis increases again from 125 to 150. Your adjusted basis is now 150. Then you decide, you know what? I don't want a pool anymore and I don't like my kitchen. So I'm gonna sell my house and move into an apartment by the beach. You sell the property for $650,000. It's a really nice kitchen and it was a really nice pool. So now you sell it for $650,000. Your gain or loss from a federal income tax perspective is the difference between your purchase price or your sale price of $650 and your adjusted basis of $150, which I'm not great at math, is $500,000, conveniently, a nice round number, $500,000. So your gain or loss is plus $500,000 in gain. If it were opposite, it would be a $500,000 loss. But for purposes of our discussion, we're talking about appreciation of gain. So we're going to keep it with the sale price of $650, adjusted basis of $150. Your gain, your taxable gain is the margin of difference of $500,000. You're going to pay or disclose income taxes of $500,000. Now, there's a primary residence exception of like $250 per spouse, so you can probably get out of it to a large degree. But I'm not talking about that today. Today we're talking about what happens when you are dealing with estate planning. If you were to give that house to me, because you're really happy with my work, I'm just kidding, I'm not allowed to accept money or property from a client. But scratch that. Say you give the house to your family member during life, while you're alive. It's called an inter vivos gift. They're going to inherit your basis. So their basis is going to be 150 also, okay? If they sell it the next day for 650, then they will have that same $500,000 gain, just like you would have had. You would have had. I can't speak. Conversely, if you gift it to them on death, their basis will not be a carryover basis. Their basis will be what's called a step-up in basis. And that means that their basis will be further adjusted upwards to the date of death value of the property. So just say, for example, the date of death value of the property was 650. Their basis goes from 150 to 650, which coincidentally is the fair market value. We just said that. So if they were to sell it the next day, their basis, their adjusted gain or loss is zero. 650 minus 650. Extreme example, overly generalizing everything. Do not make decisions based on this, but just understand the concept. This matters. That's a $500,000 gain or loss difference by just being smart and thoughtful with your planning. I'm putting aside liability, I'm putting aside gifting, I'm putting aside a lot of other issues just to convey my point about basis. So please don't, think it's that simple. It's not. So basis is important. it's a big part of estate planning now, with the exemption being $22+ million per spouse, two spouses. You know, it's political in nature. There's been a lot of fighting over trying to get rid of adjusted basis and step up in basis. But for now, this is the rule, and that's what we do. So thank you for stopping by. I hope you found this helpful, and stay tuned for more.